Your coffee shop survived its first month. 13 transactions, a balanced equation, and then your phone rings. It's the bank, the one that lent you $1,000, and they want one thing. Prove it. Show exactly where every dollar came from and exactly where every dollar went. You open your notebook and it says, money came in, money went out. That's not bookkeeping. That's a fortune cookie. Today you learn the tool accountants have trusted for 500 years. It looks like the letter T, and by the end, you'll write entries like a professional. Stay to the end, because the whole chapter fits on one card you can screenshot. First, the homework. I left you with one unsolved customer, $120 of espresso cups on account. If you worked it, welcome back. Supplies up $120, you own the cups. Accounts payable up $120, you owe for them. Equity feels nothing. That's the Chapter 1 answer, and it's perfect. But here's the thing, no accountant on earth writes it that way. By the end of today, you'll write that exact same answer in 2 short lines, the professional way. Hold that thought. Word of the day. An account. An account is an individual accounting record of the increases and decreases in a specific asset, liability, or owner's equity item. Baby version, an account is 1 page in the shop's diary. 1 page for cash, 1 page for equipment, 1 page for revenue. Anything that goes up or down gets a page of its own. Here's what a page looks like, and it's called a T account because it looks like the letter T. 3 parts, that's the whole anatomy. 1, the title, the account's name, written on top. 2, the left side, called the debit side. 3, the right side, called the credit side. And now forget everything scary you've ever heard about those words. Debit means left, credit means right. That's it. DR and CR for short. No good, no bad, no gain, no loss. Just left and right. Does the left side of this slide feel familiar? It should. It's your own work. Maple Beans Cash. First 5 moves of the month, exactly how Chapter 1 taught you. Plus $10,000, your investment. Minus $6,000, the espresso machine. Minus $300, supplies. Plus $4,000, a week of sales. Plus $1,000, the bank loan. The column adds to $8,700. Those were your training wheels, and you rode them like a champ. Now the right side, the same 5 moves, folded into a T. Every plus goes left, the debit side. Every minus goes right, the credit side. Debits total $15,000, credits total $6,300, and the difference is called the balance, $8,700, sitting on the debit side, because debits won. Same numbers, same truth, new box. Now flip it. Accounts payable, the shop's promises straight from your month. You owed $600 for supplies, $450 for the grinder, $400 for the ad bill, and you paid $600 back. But this page is a liability, so the signs flip sides. The increases live on the right, the credit side, $600, $450, $400. The one decrease moves left, $600. Credits total $1,450, debits total $600. Balance $850. On the credit side this time, because credits won, and that $850 should look familiar. It's the exact accounts payable number your balance sheet reported in Chapter 1. Own this little T. Every account in accounting is just one of these, filling up on both sides. And if that landed, notice what just happened. I didn't teach you a new fact. You reread one you already owned. Pop quiz, 30 seconds. Don't skip it. A T account shows $7,000 and $2,000 on the debit side, $3,000 on the credit side. Question 1. What's the balance and which side does it sit on? Question 2. A different account. Debits of $4,000, credits of $2,500 and $3,500. Balance and side. Pause here and try it yourself. Ready? 1. Debits $9,000, credits $3,000, balance $6,000. Debit side, debits 1. 2. Debits $4,000, credits $6,000, balance $2,000, credit side. Both, right? You already think in T accounts. So who grows on which side? Here's the map, and you read it like directions, not vocabulary. Assets equal liabilities plus capital minus drawings plus revenues minus expenses. Chapter 1's own equation just opened up. Every term here carries a sign, plus or minus, and that sign alone decides its debit and credit rule. Watch where each term lands. Start on the far left with assets, the piece you already own. Assets sit on the left of the equal sign, so assets grow on the left, the debit side. Same word, same side. Now cross the equal sign. Liabilities and capital carry plus signs on the right, so they grow on the right, the credit side. And now the two troublemakers. Drawings and expenses are equity too, but they carry minus signs, and a minus sign flips the rule, so they grow on the debit side with the assets. Notice what just happened. Assets, drawings, and expenses landed on the debit side, DEA. Liabilities, owner's capital, and revenue landed on the credit side, LER. Put them together, dealer. One caution before we use it. That E is owner's capital specifically. Drawings and expenses are equity too, but their minus signs push them across to the debit side, exactly as the map showed. You didn't memorize that, you derived it. And that side has a name the exam will ask for. An account's normal balance is simply the side it grows on. So assets, drawings, and expenses carry normal debit balances, and liabilities, capital, and revenues carry normal credit balances. Normal balance, nothing more than the side that makes the account bigger. And here's the part exams love, what each of those does to equity. Owner's capital, the money you put in, pushes equity up. Revenue, what you earn, pushes equity up. Expenses, what you consume, pull equity down. Drawings, what you take out, pull equity down. That's my favorite tip in all of accounting, and it's why the minus terms grow on the debit side. They are the equity shrinkers. Expense up, equity down. Revenue up, equity up. And if you want more reps on these 6 rules, derived slowly, transaction by transaction, we made a whole separate video, debits and credits, the rule that makes them impossible to confuse. Link is in the description, and it's worth 12 minutes of your time. Now watch the map work. 2 steps, every time, forever. The espresso cups, one more time. Step 1 is pure. Chapter 1. What moved? Supplies up 120, accounts payable up 120. Step 2, read the map. Supplies is an asset going up. Assets grow by debits, so debit supplies 120. Accounts payable is a liability going up. Liabilities grow by credits, so credit accounts payable 120. Done. 2 lines, and the homework is closed. The professional way. Chapter 1 tells you what moved. The map tells you which side. That is the entire game. And the famous name from Chapter 1 now gets its full title, the double entry system. Every transaction is recorded in at least 2 accounts, and total debits must always equal total credits. Money never appears from nowhere and never vanishes into nowhere. It always comes from one account and goes to another. That's why the books can always be checked, and that's why the bank can always get its answer. Which leaves one practical question. How do we write all this down, day after day, without losing our minds? With a 3-step assembly line called the recording process, and it runs the same in every company on Earth, from Maple Bean to Apple. Step 1, analyze. And real companies never analyze from memory. They analyze business documents, a receipt, a check, a bill, the paper evidence of what happened. Step 2, journalize. Write the entry in a book called the journal. Step 3, post. Copy the entry into each account's own T inside a book called the ledger. Analyze, journalize, post. 2 of those words are brand new, so let's meet them properly. The journal is the book of original entry because every transaction lands here first, in chronological order, day by day, a diary with dates. And this is the part students skip because it looks like paperwork, and then they cannot work out why nothing balances 3 steps later. Do not skip it. And the format has strict manners kept for 500 years. The date goes in the left column. The account to be debited is written first, at the margin. The account to be credited goes on the next line, indented to the right, always. Amounts sit in their own debit and credit columns. Why the indent? So anyone can read a journal at a glance. Flush left means debit. Indented means credit. Let's journalize your month, and for every one of them, you see the transaction first, then the entry. Transaction 1. You invest $10,000 cash. Cash is an asset going up, so we debit it, and the claim is yours. So owner's capital, equity, is credited. Transaction 2. The espresso machine. $6,000 cash. Equipment arrives, debit it, cash leaves, and a shrinking asset goes to the credit side. That is the Chapter 1 swap, now written in journal language. Transaction 3. Careful, this is the compound 1. 900 of supplies, 300 paid in cash, 600 on account. Supplies up 900, debit. Cash down 300, credit. And the unpaid 600 is a brand new promise. Credit accounts payable. 3 accounts in 1 entry. And the debits still equal the credits. Transaction 4. The shop earns. A week of sales, $4,000 cash. Cash up, debit. You gave up effort, not an asset. So it is revenue, credit service revenue, and equity grows. Transaction 5. The office catering, $2,000 on account. The work is done, so the revenue is earned now. Credit service revenue. No cash yet, and what you hold instead is the IOU, an asset, so debit accounts receivable. Transaction 6, the bank loan, $1,000, cash up, debit. But borrowed money is never revenue. It goes back one day, so credit notes payable. That is the bank from the top of this video, and this is their page, now on your books. Transaction 7, the grinder from the focus homework, $450 on account. Equipment up, debit. A promise is born, credit accounts payable, and no cash was touched at all. Transaction 8, rent, $500. The month of space is already gone. There is nothing left to own, so that is an expense. And expenses grow on the debit side. Debit rent expense, credit cash. Expense up, equity down. The inverse pair live in front of you. Transaction 9. The office pays its $2,000, the swap you proved in the quiz. Debit cash, credit accounts receivable, and no new revenue, because you earned it back in Transaction 5. Now, something happens that is not a transaction at all. You hire a barista, you shake hands, she starts Monday at $15 an hour. What's the entry? There isn't one. Hiring changes nothing you own, nothing you owe, and nothing you're worth. No asset moved, no liability was born, equity is untouched. The event is real. It just isn't a transaction, and accounting records transactions. The moment she actually works an hour, that changes, and that is exactly the next entry. Transaction 10. You take $200 home for groceries, not a business cost, so not an expense. It's drawings, a direct cut to equity, debit owner's drawings, credit cash. Transaction 11. The monthly bills, one compound entry, and manners say all debits first. Salaries $900, utilities $300, advertising $100. All 3 debits, and one pocket paid for all of it. So a single credit to cash, $1,300. 4 accounts, 1 entry, still perfectly balanced. Transaction 12. The $400 ad bill arrives and you postpone paying. The ad already ran, so debit advertising expense, credit accounts payable. Recognition doesn't wait for cash. And Transaction 13, you pay the $600 you owed for supplies. A shrinking liability moves to the debit side. Debit accounts payable, credit cash. Equity feels nothing. You settled old business. 13 for 13, every entry balanced and every side chosen by the map. Take one breath here because you have just journalized an entire month of a real business, and 4 chapters ago, you did not know what a debit was. Step 3 needs a destination, the ledger, also called the general ledger. If the journal is the diary sorted by date, the ledger is the binder sorted by account. Every account's page in one place, arranged in the order of the expanded equation. Assets first, then liabilities, then capital, drawings, revenues, expenses. And here's the connection that makes it easy. Every page in that binder is a T account, the exact T you already own. In real offices, the page usually wears a different costume, date, debit, credit, and a running balance, like your bank statement. Same information, same left and right, just dressed for work. We'll stick with the T, it's cleaner to learn from. Now posting, and I want you to see exactly how it's done, because it's a procedure, not a mystery. 3 moves, every single time. Move 1, in the ledger, find the account named on the journal's debit line, and enter the date and the amount on the left side of that page. Move 2, find the account named on the credit line and enter the date and the amount on the right side of its page. Move 3, back in the journal, write the ledger page number in the reference column. And that little number is how you prove the entry was posted. Nothing unposted, nothing posted twice. Now watch it on your own first entry. The journal says debit cash $10,000, so we open the cash page and write $10,000 on its left. It says credit owner's capital $10,000, so we open the capital page and write $10,000 on its right. Entry 2, debit equipment $6,000, equipment page left side. Credit cash $6,000, back to the cash page, and this time it lands on the right. Look at cash already collecting its story. Money in on the left, money out on the right. Now we post the entire month, and the board fills like a scoreboard. This is the slide I used to put on the board and simply let the class sit with, because when it clicks for good. Entries 3 through 13, each debit to the left of its T, each credit to the right, in journal order. Then draw the line under every page and let each T announce its balance. Cash, $17,000 in, $8,900 out. Balance $8,100. Debit side, supplies $900. Equipment $6,450. Accounts receivable $2,000 in, $2,000 out. 0. The page closed itself. Accounts payable $850. Credit side, the number you met earlier. Notes payable $1,000. Capital $10,000. Drawings $200. Service revenue $6,000. And the expenses, rent $500, wages $900, utilities $300, advertising $500. Every page now holds its truth, and these balances are about to line up for inspection. Quiz 2, and this one catches even accountants. Monday morning, you hire a barista. $900 a month, she starts next week. Write the journal entry. Pause here and try it yourself. Ready? No entry, nothing to record. No asset moved, no liability was born. No equity changed. Nothing has happened to the books yet. The wages become an entry when she works and the shop owes her, not when she signs. An agreement is a plan. Accounting records events. The inspection is called the trial balance, a list of every account and its balance at one moment, debits in one column, credits in the other, built straight from the 13 entries you wrote. Debit column, cash $8,100, supplies $900, equipment $6,450, drawings $200, rent expense $500, wages $900, utilities $300, advertising $500, the $100 you paid plus the $400 bill. Total debits, $17,850. Credit column, accounts payable $850, notes payable $1,000, capital $10,000, service revenue $6,000. Total credits, $17,850, a perfect match. And notice who's missing. Accounts receivable, billed $2,000, collected $2,000, the page closed at 0, so it has nothing to report. Every number here traces back to an entry you can point to. Why do accountants love this page? 3 reasons. 1. It proves total debits equal total credits, the mathematical heartbeat of double entry. 2. It helps uncover errors. If the columns disagree, something went wrong in journalizing or posting, and you know to go hunting. 3. It's the required first step toward the financial statements you met in Chapter 1. No trial balance, no income statement. Now the warning, and exams love it. A trial balance can balance and still be wrong. 4 sneaky cases. A transaction never journalized at all. A correct entry never posted. An entry posted twice. Or the right amounts pushed through the wrong accounts. In every one of those, debits still equal credits. The columns match, and the error hides. Baby version. The trial balance checks that the scale is level, not that you weighed the right things. That last case deserves a fix because it nearly happened to you. Go back to transaction 7, the grinder, $450 on account. Now imagine the bookkeeper wrote debit supplies, $450 instead of debit equipment. The credit to accounts payable was fine. The totals were fine. Add the columns and the trial balance still balances perfectly. But look at what the books now claim. Supplies reads $1,350 when the shelf only ever held $900. Equipment reads $6,000 when you own $6,450. The books show supplies you do not have and hide equipment you do. The repair is called a correcting entry, and there are 2 ways to do it. Method 1 is the eraser method, 2 clean steps. Step 1. Reverse the wrong entry completely. Debit accounts, payable $450, credit supplies $450. That erases the mistake as if it never happened. Step 2. Record the correct entry, the way it should have been written in the first place. Debit equipment $450, credit accounts, payable $450. Now walk the pages after those 2 entries, slowly, because this is where it clicks. Supplies, $900, plus the wrong $450, minus the $450 we reversed. Back to $900, telling the truth again. Equipment, $6,000, plus $450, $6,450. Finally, on its own page. Accounts payable, untouched in the end, $850, exactly what you owe. The books are honest again. But method 2 gets to the same place with 1 entry, and here is the baby simple way to see it. Accounts. Payable was never wrong. You really do owe that money, so do not touch it. The only problem is that $450 is sitting on the wrong page. So make one move. Debit equipment $450, putting the amount where it belongs. Credit supplies $450, lifting it off the page where it never belonged. Like a library book left on the wrong shelf, one move, right shelf, done. Now compare them. Method 1, 2 entries. Method 2, 1 entry. And the ending is identical either way. Supplies $900, equipment $6,450, accounts payable $850. Pick whichever your brain likes best, and never scribble a correction over the top of an entry. The audit trail is sacred. You fix a mistake by writing another entry. And how do companies stop wrong account mistakes before they happen? A chart of accounts, the ledger's table of contents, a numbered menu of every account the company uses, Maple Beans chart, assets in the 100s, cash 101, receivables 112, supplies 126, equipment 157, liabilities in the 200s, equity the 300s, Revenues, 400s. Expenses, 500s. Balance sheet accounts first, income statement accounts after. See the gaps between the numbers? On purpose. New accounts slot into the gaps as the shop grows. Now look at this page hard, because it is not a trial balance, and students mix these two up on every single exam. You built the trial balance a few minutes ago, the one that totaled $17,850 on both sides. Hold the two side by side. The chart is the menu, names and numbers, no dollar amounts anywhere, and it barely ever changes. The trial balance is the snapshot. Real balances, one date, made fresh every time. The chart tells you what accounts exist. The trial balance tells you what they hold right now. Menu versus snapshot. Zoom out. You've earned the view. Everything accountants do, every period, follows one loop, the accounting cycle, 9 steps. Analyze, journalize, post, trial balance. Look where you're standing, you've already done all 4. That's the entire recording half of the cycle. Conquered. What's left? Adjusting entries and the adjusted trial balance. That's Chapter 3, where we make the books tell the truth. The statements you met in Chapter 1. Closing entries, Chapter 4. And the post-closing trial balance that resets the loop. 4 down. 5 to go, and you're ahead of most first-year students. Screenshot this, the whole of Chapter 2 on one card. The T, title on top, debit left, credit right. The map, ADE grow left, LCR grow right. Reads straight off the expanded equation. Double entry, at least 2 accounts. Debits always equal credits. The pipeline. Analyze, journalize, post, and the trial balance, a matching test that proves the columns agree but cannot see a missing entry, a doubled entry, or the right amount on the wrong page. And right beside that warning, the repair for it, a correcting entry. One move, debit the page it belongs on, credit the page it never did. So pause here and screenshot it. Or, better, point your phone at the code in the bottom right corner that opens the printable version of this exact card. Free. Either way, this one card answers most of what an exam can ask you about the recording process. Chapter 1 gave you the equation. This chapter gave you the recording machine. These two are the foundation. Everything else in accounting is built on them. Before you go, your books are hiding something. Your trial balance matches to the penny, and some of its numbers are already lying. The books say supplies, 900. Walk to the closet and count. There's less. You've been pulling cups and beans off that shelf all month. Who's right, the books or the closet? That's Chapter 3, Adjusting Entries, where we make the books tell the truth. Your homework, and I'm not solving this one. Maple Bean pays $250 of what it owes on the grinder. Write the full journal entry. Both lines, proper manners. The worked answer is with the free notes, exercises, and mock exams at appliedanalyst.com. Link below. If anything felt fuzzy today, tell me exactly where in the comments. I read every one. Every accountant you'll ever admire once sat exactly where you're sitting. Future CPA. See you in Chapter 3.